Hi everyone, and welcome to the Buffett and Beyond Stock Analysis video podcast. And this week we are going over the apparel industry, and with your host, Dr. Joseph Belmonte, which is me, and Debbie with a Y. Hi, Debbie.
Hello, that's me.
And these methodologies are based on the book Buffett and Beyond, second edition, published by Wiley Publishing. And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. Now remember, folks, the clean surplus return on equity is both a comparable and a predictability model and is totally different than the traditional accounting return on equity, so don't get them mixed up. And you can equate the clean surplus return on equity as the interest rate you get from a bank. So this is common sense now. A bank account with a higher return or interest rate will earn you more money than an account earning a lower interest rate. So it just follows that portfolios made up of stocks with high clean surplus ROEs or return on equity will outperform other portfolios made up of stocks with lower return on equity or interest rates. So think of your bank account when we talk about these stocks. And yes, folks, it's that simple. So Debbie, let's go over our first stock of the day.
All righty, JB. Hello, everyone. Hanes Brand Incorporated is a leading apparel company that designs, manufactures, and sells clothing for men, women, and children globally. Its product portfolio includes t-shirts, bras, panties, men's and kids' underwear, socks, hosiery, casual wear, and activewear. Brands include Hanes, Champion, Playtex, Bali, Just My Size, Legs, and Wonder Bra. They acquired Maidenform in 1013, DB Apparel 814, Knights Apparel in 415, and Pacific Brands in 7 of 16. They have about 67,200 employees.
Okay, thanks, Debbie. And let's look at the numbers. And folks, we want to look at that clean surplus return on equity. And the average stock in the S&P 500 has a 14.5% clean surplus ROE. Now you can see that Hanes Brands has a higher than average clean surplus ROE, but that is not the whole story. Let's go over here into the net income growth and the revenue growth, and let's look at the 5-year average. And with the net income growth, this growth of 7% is about half that of the average stock in our stock program database. And the revenue growth is about half that of the average stock in our database. So even though the clean surplus ROE looks good, when we look a little further into net income growth and revenue growth, they are about half that of the average stock in our database. So when we look at the return for the past 12 months, we can see this rusty colored line is Hanes, and we can see it's down about 15%, while the market, represented by the S&P 500 index, this black line, is up about 6%. So there's a big difference in the past 12 months, and that's because the market recognizes that revenue growth and the net income growth is about half that of the average stock. And when we look over 5 years, we can see with the market up about 55%, this stock is down about 8 or 9%. So folks, we don't like this stock in our portfolio. So let's get right on to the next stock.
Alrighty then, it's Michael Kors Holdings Limited, and they engage in the design, marketing, distribution, and retailing of branded men's and women's apparel, accessories, footwear, and fragrances. Operates 4 segments: retail at 57%, wholesale at 35%, licensing at 3%, and Jimmy Choo at 5%. Primary brands include Michael Kors Luxury Collection, Michael Kors Accessible Luxury Collection.
Wow.
I don't know why is one accessible. Okay, and Michael Kors Men's. As of March 31st in 18, they were owned and operated 379 retail stores in North America and 450 international stores, mostly Europe and Asia. And they acquired Jimmy Choo in 11 of 17 and employ about 14,846.
Wow. Okay, so let's get right to the numbers. And right now we see the clean surplus return on equity a little bit higher than average. So right away we want to look further at this stock. And then we come to the net income growth at 5.6%. And folks, I'm sorry, but this is about 1/3 of the average net income growth of the average stock. So no, we don't like this at all. If the net income growth is not growing more than the average stock, we don't even want to consider this stock. And revenue growth is again up below the average stock in the S&P 500 and the average stock in our database, with the 5-year average about 17%, and here it's 11.2%. So we don't even consider getting into a stock with a below average net income growth or revenue growth unless all the other numbers are super fantastic. And folks, this stock is not. So when we look at the returns over the past year, they were doing pretty well for a while until with this recent market drop, not so well at all. So with the market up about 7-8% over the past year or so, this stock is down 10%, and over 5 years with the market up 55%, this stock is down almost 45%. So no, we don't like this stock. The market recognizes the very low growth in revenues and very low growth in net income. And you can equate net income for these purposes as earnings. So if they're not increasing their revenue growth, they are certainly not going to increase their earnings growth. So Debbie, what's our next stock?
All righty, that's VF Corporation, the world's largest publicly held apparel supplier. And they're a leader in the jeanswear, outdoor, sportswear, and workwear market. Have the largest share of the jeans market in the U.S., and they also sell footwear. Brands include Lee, Wrangler, The North Face, Vans, and Kipling. They acquired Timberland in September of 11, sold intimate apparel business in April of 7, sold contemporary brands business in 8/16, sold Nautica in 4/18, and they're selling more than it's buying. Exactly. And they employ about 69,000 people, and foreign sales account for 41% of total.
We brought up foreign sales for a reason, folks, because with the stronger dollar, that makes these goods made in the United States and exported overseas more expensive over there. So people overseas will buy fewer products, and the market sees this with the strong dollar. So that's one of the things that we worry about, and not even counting any kind of tariffs that they put on our exported goods into these other countries. So just the strength of the dollar will mean higher costs for their products overseas, and that means less profit going forward. And when we look at the numbers, we've seen the clean surplus ROE has been rising a little bit, which is a good sign. However, when we get into net income growth, folks, same story with the other two stocks. The net income growth is about 1/3 of the average stock. So that's not going to increase the net income or the growth of the stock. And revenue growth, folks, this is about 25% of the average stock. So if the revenues are not growing, that means that net income, which we can equate as earnings, will not grow. So we have a problem here, folks, and the market recognizes that. And a good thing we look further into this stock with the net income growth and revenue growth, because this is not a kind of stock that we want to get into for our growth portfolios. And when we look at this stock over the past year, and this is the rusty colored line, folks, it's been doing pretty well for the past year. So it's not a bad stock relative to the market at this particular time. But when we look over 5 years, it's about 50%, while the market is up about 58% over 5 years. So folks, if you're going to buy a stock that's underperforming the market or performing only as well as the market, you might as well buy the market and be totally diversified. So this stock is not doing it. And when we look at all three stocks put together, we can see the ROEs are not bad. They're all above average. However, when we looked further, we could see that net income growth was lower than the average stock, and the revenue growth, a very, very important revenue growth, is way below the average stock. And this shows up in the 5-year returns of all these stocks, with the black line being the S&P 500. So all three stocks are underperforming the S&P 500. And therefore, folks, we don't want to look at these stocks. I know a lot of you asked about these stocks, especially cores. Folks, we don't want these stocks in our portfolio. There's better growth stocks elsewhere, as we go over every week in this portfolio.
Well, JB, I think we've just about covered all of the questions sent in by our listeners out there in investment land. And remember, folks, we're here to answer your questions, not only about individual stocks, but also about the stock market in general. So keep the questions coming. And who knows, we may even answer a question or two you didn't even know you had. That's about it for today, JB.
Okay, folks, don't forget, if you want to receive a free full month of all our letters and complete access to the computer program, just go to our site and sign up. And remember, all you need to manage your own portfolio is there, and we give it to you all the time, constantly. And folks, it's free.
Free.
Just go to Buffett and Beyond, and remember that Buffett is spelled with 2 F's and 2 T's. That's BuffettandBeyond.com. Well, folks, we had a great day today.
And tomorrow will be even better.
All right, bye, folks. We'll see you next time.
Bye, everyone.
That's where